Welcome to ForexTV.com. Today's Friday, March 27th. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is higher against the majors, but weaker against the yen. Dollar strength also leading oil and gold lower. U.S. equity markets are lower today, but still sharply higher on the month of March. Now for a quick look at the latest headlines from the CEP News Desk. U.S. personal income falls as spending climbs. U.S. consumer sentiment revised higher. German inflation falls to the lowest level in 10 years. Monthly U.S. personal income drops as spending climbs. Personal income fell slightly more than expected in February, and personal spending moved higher. That according to a report released by the U.S. Department of Commerce. Total spending rose 0.2% in the month, in line with expectations, following an upwardly revised 1% increase in January. Annual spending has fallen 0.4%. The personal income category resumed its downtrend after a brief bump higher in the month prior, moving lower by 0.2% in the month against a consensus expectation for a 0.1% decline and following a 0.2% climb in January. Compared to 12 months ago, incomes are up 1% against 1.9% in the January report. Compensation was down 0.3% in February after a flat reading in January, while wages and salaries fell 0.4%, adding to the 2.2% decline in January. U.S. Consumer Sentiment Index revised higher in March. The final Consumer Sentiment Survey from Reuters and the University of Michigan for March was revised up from preliminary estimates, bringing the headline index higher to 57.3 compared to the preliminary level of 56.6. Economists were expecting an upward revision to 56.8. The economic outlook component was revised up to 53.5 in March compared to the preliminary 53 level and February's reading of 50.5. Economic conditions component was revised up to 63.3 from a 62.3 reading in the preliminary estimates and follows February's 65.5 reading. One-year inflation expectations were revised to 2% from 2.2%, that following the 1.9% figure in February. Five-year inflation expectations fell to 2.6% from the 2.8% reported in the preliminary report. That followed the prior month's 3.1%. Over in Europe, German inflation falls to the lowest level in nearly 10 years. Fuel prices in Germany have pushed inflation to its lowest levels since July of 1999. That according to preliminary estimates from the Federal Statistics Office. The Statistics Office reported that German inflation came in at 0.5% in the 12 months to March, down from both the 0.7% figure expected and February's 1% print. The easing in inflation is mainly due to the upward trend in liquid fuel and motor fuel prices. In March, motor fuel prices fell between 17.5% and 19.2%, while liquid fuel costs fell as much as 38.6%. In the UK, GDP falls 1.6% in the fourth quarter. UK GDP fell 1.6% in the fourth quarter of 2008, with deterioration noted in all components, according to the Office of National Statistics. Initial estimates had pointed to a slightly more modest decline of 1.5% quarter over quarter, following Q3's 0.7% slide. According to the Statistics Office, consumer spending contracted 1% in the quarter on quarterly terms, while investment slipped 1.4% over the same period. Today we're joined by Meg Brown, currency strategist at Brown Brothers Harriman. Meg, welcome to the program. Thanks for joining us.
Thank you for having me.
Meg, we've seen a lot of action. Equity markets sold off on the news this morning, and even prior to that, the futures were pointing to a lower open, and dollar has seen some strength. Is this just making up ground for the run-up we had in the prior 2 weeks, or do you think there's something else at work here?
I think there are a couple things, but it's definitely part of it is related to the time of year. This is the month and quarter end, and for Japanese investors, it's the fiscal year end, and that means that a lot of repositioning occurs in a number of markets. Hedges are shifted depending on how equity markets have done. There's just a general shift, cutting positions back, squaring up ahead of the end of the quarter. So that is one of the factors. I'd say today's data, of all of the data for the U.S., I'd say that personal spending was the important one. What it shows is that for 2 consecutive months we've had an increase in spending. That compares with 6 months of declines in spending, and it's an encouraging sign. I mean, we had 6.6% contraction in GDP in Q4. This data suggests that perhaps, this and other data suggests perhaps the worst is behind us. And that's been one of the factors. We've seen this data for a few weeks. We've been seeing some improvement in data compared to Q4. I think that's one of the things that actually weakened the dollar recently. The reason being that very dismal data has tended to support the dollar. It's been an attractive sort of safe haven currency.
Meg,
it's switching now. Yes.
Let me jump in there. I've been looking at the numbers. Retail sales came in a little bit higher than expected on a consistent basis. Last 2 reports, right?
Mm-hmm. Yes.
But, we've got record unemployment. Mm-hmm. We have lowering of wages, yet we have increased spending. You do the math here, and it just doesn't add up. So, help me out here. How does that happen, and why do we put so much weight behind that? I know it's an improvement in the numbers, but doing 1 plus 1 is does not equal 4, and that's what these numbers to an honest guy like myself just doesn't seem to add up.
Well, there are a number of reasons why spending could increase. I mean, last year at this time when we had record oil prices, the disposable income available to people to spend on other things than oil was quite small. Now, oil's included in this spending, but the price is much lower. The fact that some prices have come down may be helping other prices, but even in real terms, we're likely to see spending contribute to growth. I think that we still have elevated savings compared to what we had a year ago, but I think the spending comes from more positive sentiment from delayed spending last year. I think it ties in with the confidence. So with the confidence, not that the confidence is back to non-recessionary levels, but it's better than it was. I think that people are willing, maybe because there were a lot of sales, maybe because of pent-up demand, but they did go out and spend. It can have an impact on savings. It can drive it back down. But I think the positive thing is people are spending, which means inventories, the huge inventories we have have been drawn down, are being drawn down a little faster than we thought. And it looks like spending or consumption is maybe one of the first areas to recover. Yes, employment's a lagging indicator, and it's hard to see why that would lead to a pickup in spending. But it's one sector of the economy, and there are other sectors that may feel more comfortable about spending. But again, we also had tremendous sales.
Right. So before we get into specifics, how does this trend affect your approach to the markets? Let's say going into quarter end, we still have a couple of days next week to deal with the end of this month. Do you see this dollar strength continuing into next week? And would you think that the larger players have already repatriated their dollars at this point? Is this more market sentiment than actual repatriation or repositioning?
I think that some of the moves we've seen are definitely repatriating, and I would say that you could see that with Japan, where the yen has been strengthening today. Some of that is probably flows back into Japan at quarter end, and those will dissipate as the new year opens up. I think actually one of the things that weighed on the dollar in over the last week or so against, say, the euro, is that the U.S. stock markets actually Japan performed the best, but U.S. stock markets have performed better than European stock markets. And what that means is that people who are hedging their equities, foreigners hedging their equities, have to increase the sale of dollars to boost their hedges, and that could be it's just one thing that could contribute to the dollar's recent weakness. Now that we're approaching the end of the year, of the quarter, I think we're seeing some squaring up of that. I also think I think the market really, after the FOMC meeting, the euro and the Swiss franc, and to some extent the pound, moved into a higher trading range, and they weren't able to take it yet another leg higher. They ran out of the momentum and the ideas that would push it higher, and I think now we've corrected. In the big picture, I think the dollar is likely to gain strength toward the end of the quarter, and I think it will, because I think we'll see more and more signs that the U.S. is recovering ahead of other countries. I think in the short run, that is, in addition to quarter end, I think that's having an impact on the currencies, a positive impact on the currencies against the dollar. But over time, it's going to become a growth story, and we're likely to see the dollar strengthen further.
Okay, Meg. So let's stay on euro for the moment. ECB is going to meet next week.
Mm-hmm.
Smart money says that they absolutely have to do something next week. Do you subscribe to that as well? Yeah,
and I think what's going to be important to watch for the ECB next week are two things. First of all, the importance of the refi rate has lessened. The ECB has made it more and more clear that what they're focusing on is their deposit rate, which is the rate banks pay to borrow from the central bank. So here's the deal. That repo rate is 0.5%. They're likely to cut it 25. So now the ECB will have rates at 0.25%, in line with the Fed, Switzerland, the UK, Japan, all who have rates very close to zero. Yes, they'll cut the refi rate, probably 50 basis points, but that's not really the focus. The focus is what they do with the depo rate. And the second thing is what they're likely to say about expanding their balance sheets. Mm-hmm. Some people are arguing that they're introducing quantitative easing possibly at this April meeting. I'd say that they've already done that sort of thing. Their balance sheet has already been expanded, and we're going to see, and they're likely to at least say this is what we will do to expand the balance sheet further. So I'd look for those factors, and I'd say those could be a negative for the euro when other central banks like the Bank of England or the Fed have introduced details of quantitative easing. It's usually resulted in their currencies weakening. So I think that'll actually help the dollar next week against the euro.
Okay, Meg, this is a larger story, but I do want to just follow up on this. Papademos came out saying they may be buying corporate bonds in the secondary market. It's a tricky situation there, but they have kind of opened the door to this quantitative easing.
Yes, they have.
And maybe, knowing that they have to kind of do it through the back door because, an overt, open quantitative easing announcement may just, cause a rush for the exits.
It could make people nervous, yes, and it could have that impact. I think that's one of the things that could weaken the euro. By the way, I think there are three or four key things that'll happen next week that'll influence the dollar. One is this meeting. One is the G20 meeting. And I think that the risk there is really just an event risk. I don't really expect anything to come out of it, but some politicians have hinted about talking about FX, and so I think people will be a little nervous about that and just be careful ahead of the meeting. The third thing is the U.S., and next week we have more data that's likely to point to some improvement in Q1 growth. That's great, but at the end of the week we get another dismal jobs number. And I think just what you were trying to get me to comment on about, okay, we've got increased spending, retail sales are up, but how's that working if employment is coming off? I think that point will be tested next week when we have another dismal employment number.
Yeah, that was an unfair question for you, but I had to do it. The devil made me do it, Meg. Meg,
well, it's a good point, but we do see we think consumer spending's picking up. a little bit. People are in a slightly better position. I do think there will still be layoffs. We'll probably see them. Jim's been talking about one of the companies that's like to see more layoffs. But what we do get again in Q2 is the start of the stimulus package, which is also going to help growth and going to help spending. And that could foster growth, a pickup in growth, and then rehiring. It could have a positive cyclical effect, or a positive effect that scrolls forward to improved growth.
Okay. So, Meg, I want to move along here. We have time for one more, and I talked to you about the commodity currency, specifically Aussie. There seems to be a lot of interest building in the options markets for Aussie, and with the CRB making gains, albeit it's come off its highs. What do you make of a currency like Aussie at this point?
Well, I think Aussie had. I think that these are put options, so that's the right to sell Aussie.
That's right.
And I think there could be many reasons those positions are put on, but I do think there's a risk. We've seen Aussie come off today. There is a risk for an Aussie and Kiwi pullback. Both currencies have strengthened quite a bit in March. So if the U.S. dollar, which is what we think this next coming week, gains more ground, that could weigh on the Aussie and Kiwi, and we could see a deeper correction.
Okay.
I think what's been driving Aussie is not just the commodities, but the fact that Aussie and New Zealand are in the Asia-Pacific region, and the outlook has been that China appears is providing stimulus to the economy, and that's going to help the regional currencies most. In fact, a lot of the Asian currencies did quite well this week. And I think that's another sign that people are looking to China for sort of the engine of growth. In the U.S., a comparative currency is Canada. And I think I've been long Aussie against Canada, partly because I think Aussie has been benefiting, or because of the idea Aussie benefits because it's near China, which may come out ahead of the U.S. in terms of picking up, or Canada's economy is lagging behind. It has a budget deficit, and that's because it's tied to the U.S. where growth is weak. Likely to pick up in the U.S. toward the end of the year, but still with China, with Canada lagging behind, especially given its auto exports, which are weak.
Okay, Meg, we're going to leave it there. I enjoyed talking to you today. Thanks for sharing your time with us.
Thank you. Nice to be here. This
has been your New York Forex Market Buzz with Meg Brown of Brown Brothers Harriman. I'm Tim Kelly. Join us later this afternoon for PM Exchange, right here on forextv.com.